Cisco stock closed at $109.59 on August 20th, 2026, down 15.7% from its June peak. And the reason is a classic Wall Street disconnect. The company beat expectations on revenue, beat on earnings, and guided above consensus. And investors sold anyway. The culprit was shrinking profit margins on rising memory costs, plus guidance that felt too cautious for a stock that had nearly doubled in a year. Here's how that happened. To understand why the market reacted the way it did, you need to know where Cisco stood before the numbers came out. Heading into its fiscal fourth quarter earnings report on August 13th, the stock was on a tear. Over the prior 12 months, it had climbed from about $67 a share to a peak of $130 in early June, a 94% run fueled by AI infrastructure optimism. In May, a strong third-quarter report sent shares up more than 13% in a single day. By the time Cisco reported, the street expected revenue around $16.8 billion. Cisco beat that number. Revenue came in at $17.3 billion, up 18% year over year. Earnings and adjusted earnings per share also beat. Guidance for the current quarter came in at $18 to $18.2 billion, above the $16.8 billion consensus. On paper, this was a clean beat, but there were two wrinkles. Rising memory costs were squeezing Cisco's gross margin, the portion of each dollar of revenue left after paying for the cost of making the product, and the guidance, while above consensus, was described by Piper Sandler as conservative given the current demand environment. The market's response was the opposite of what the headline numbers suggested. On August 13th, shares fell 8.4% to $113.47. The slide continued over the following days, and by August 20th, the stock closed at $109.59, the bottom of the drawdown, 15.7% below the June 4th peak of $130. There was no single new piece of bad news on August 20th. The close was the continuation of the sell-off that started a week earlier, after earnings. So why would a company that beats on revenue, beats on earnings, and guides above consensus see its stock fall? The answer is that the market doesn't price the headline numbers. It prices what those numbers say about the future and about the quality of the growth. Let's take the pieces one at a time. First, margins. Gross margin is the money left over after direct costs. In Cisco's case, the cost of the hardware it sells, including those memory chips. When memory prices rise, the cost of goods sold rises with them, and the margin shrinks. Investors saw that squeeze and read it as a sign that the AI boom, for Cisco, comes with a built-in cost that eats into the bottom line. The company is growing fast, but it's growing at a price. That's not the kind of growth the market wants to pay a premium for. Second, guidance. When a company guides, it's telling the market what to expect. Cisco's guidance was above the consensus number, so on the surface it was a positive. But Piper Sandler's characterization matters. Conservative given the current demand environment. If demand is genuinely strong and the company still guides conservatively, investors have to wonder whether management knows something about softening demand or whether it's just being cautious. Either way, the market is left guessing. And when the market has to guess, it tends to price the worst case, not the average case. A conservative guide makes investors discount the stock. Third, expectations. Cisco's stock had nearly doubled in a year. That means a lot of good news was already baked into the price. When the earnings report came out, good, but with visible cracks in the margins and a cautious tone, the market had a reason to take profits. The beat was real, but it wasn't clean enough to justify the run. So the stock dropped despite the numbers, because the numbers, on closer look, told a more complicated story. As of the end of August, Cisco closed at $109.59, still up 63% from the start of the window, but 15.7% off its June peak. The open questions are whether the memory cost margin pressure will persist through the current fiscal quarter, whether the conservative guidance was just caution or a real signal of slowing demand, and whether the AI infrastructure story can push the stock back toward $130. For now, the market has decided that Cisco's growth, while real, comes with a cost, and it's waiting to see whether that cost shrinks or grows.